was another one that gave you an opportunity, if you were long, to manage before they kind of cleaned house on it. But that elastic two-way range. We traded 76, 65, 75, and now we're right back to the lows again. Close to them, a little bit of bounce off the low. We would have looked down at down $1.70 any other day as a big down move. We were down to almost 250 at one point, if I'm not mistaken.
No,
so
right.
What are we going to cover today, my friend?
Well, yeah, so I want to take exactly what you're chirping about there, which is numbers and crude oil, and continue to, this is just the nature of markets. You spoke a little bit to it earlier about how, it's August, summer is ending, but we're still kind of in this like stuff going on in the markets, but for some reason, equity is just not moving at all. Crude oil in recent weeks has been the hot market. Yeah. Now, most of the action has been to the downside after they put in highs at $75 a barrel. But, when a market like this heats up, starts moving, 2-3 times as much as it did a month ago, that's when we start to focus on that, put a ton of data behind it, and start trading it. So that's what I did this week in the newsletter that went out to our community members. If you're not already a part of this great community, go to community.thesmallexchange.com. A bunch of data. And this, as you can see, this week's article, zeroing in on even more data in crude oil. We've got price data from 1990 until present in there, taking a look at last Monday as a case study of using standard deviations to get into and out of positions, right, and then giving you those 1, 2, and 3 standard deviations in the small crude oil market. So again, if you aren't a part of that community, we've got great stuff going on. We're packaging up a bunch of shirts to go out to community members right now, and they also get this data and 50% off trade fees. But Pete, I want to use some of this data to get into and out of crude oil markets, because we just talked about how crude oil was down more than $2 this morning, back to just being down about $1.50. And this is where we use these standard deviations that we talk about, because if you were trading this crude oil market where it's just like, oh, I want to buy it because it's down, or I don't know when to buy it, or I don't know how much patience I should have, then you've probably gotten run over a fair amount of times recently in crude oil. But looking at this, Pete, knowing the standard deviation is about $1.30 lets me know that I shouldn't really be entering into long or short positions in crude until $1.30 or $1.50, or this morning, hopefully $2, because it bounced all the way back.
Yeah, absolutely. And you know what, that's what and again, I'm biased, but my friend here puts together some of the most valuable content in terms of tradable information. I dug through an article that it was 3 pages long on something I thought was going to be interesting. And it was like, this could have been written 6 months ago, or the same article will probably be reprinted with new numbers 6 months down the road, that gave you nothing. There was no tradable takeaway. There was nothing that gave you the breaking that 50-50 edge. This is all about doing that with statistics, which, we talk about selling premium as that's the tasty trade advantage, or that is an advantage. Statistics are our advantage now. We do what we used to do intuitively, you and I, Frankie. 6.5 down in the knob spread. I'm interested in that. That's outside the normal range, where we felt our way through these levels, sometimes with success, but it was a full-time job. All of us don't have the luxury of being able to trade full-time, but we'd love to have the tools to do it. And this is a great starting point of moving the ball by an appreciable amount.
And what's great is we constantly update these numbers for those community members, but also we bring stuff to this show as well. We're not trying to hide anything necessarily. If it helps, our general broad community of viewership, we're going to bring this stuff onto the show, and it adapts with time. Because otherwise, to your point, Pete, you could have been trading crude oil since the 90s or early aughts or 2010s or what have you. This market has been as low as $10 last year and as high as $140 in terms of that spot market. And so at $75, it's like, am I trading this thing up or down $1 or $2 or 30 cents, or how should I be trading these things? So we update these statistics, and right now it's about $1.30. And you saw this hold in almost
Right.
perfectly this morning, where crude oil last night's getting hammered. During Europe, it's getting hammered. Coming into the US session, it's down a little over $2. And knowing these numbers, it's like, man, that's a good value for intraday scalping.
Right.
And the market came back to being down just $1.25, right within these ranges here. So very important, given that this market, crude oil, is a truly interesting one because, Pete, it's one of those that is dissimilar to equities in that it's historically range bound. Like, it's only been as low as, like I say, about $10 or $20 in the spot market. It's only been as high as about $130, $140.
Right.
And it hasn't broken outside of that range. Like, equities today, our small technology product, another new high. That range historically changes over time as the market drifts higher. Crude oil on an intraday basis and interday basis, depending on the extreme, is range bound. But the problem is, at $66 a barrel, 67, wherever it is right now, if you bought it just because it's lower and you're not looking at these statistics and you're not trading intraday, then you're just guessing, like, I hope it goes higher. It was as low as $10, $20 last year.
Right.
So these stats hopefully helping you approach crude oil without as much guessing.
Wow. And you know what, Frankie, I think they give you both interesting entry levels, but equally, and I can't stress this enough, equally important exit levels around comfortable management. Now, spray down another $2 almost today.
Sure.
Now, if you did have longs, it was painful, but we took out $73 on Friday, and I'm getting a little bit off track here, but you had time to manage. Now, there was a gap opening, and we traded lower from that. We're at the lows right now at 69.90, but the statistical pieces of this help not only with identifying what's a normal day, and we use that term, and I think it's a good term to use. There's lots of adjectives we could do. A normal day, what the market statistically is expecting to give us, and then what it lives outside of that. And that's where we find interest. And I think that helps with not only entry, but like I stressed, manageable. Okay, I've got a good, solid statistical entry point. I'm comfortable risking $50 or $60 a trade. Does that make sense basis where the market is? And then you've decided on your bias, your entry, and most importantly, and I say this because this is where the discipline brings up, your exit point. So mechanics of management are taken care of if you stick to it. You got a great building of a trade right there.
And I'm glad you brought up that metals piece, because that's actually an instance where these numbers didn't work out today.
No,
where it went through the one standard deviation of around $1 and then just kept going. But to your point, Pete, as long as you are trading futures intraday, you're day trading them with these mechanics of, like, all right, I'm going to take or lose 50 cents or $50 in SMO and SPRE, the same thing there, then you're flat on the day, even with such a big outlier move in metals. Yeah, the problem becomes, oh, I bought this market down $1.50. It didn't bounce back. I'm just going to hold on it. And then, to our point of where we started, then overnight risk starts to kick in. Oh, now I'm just stuck in this trend of, and you and I know this, and this is why we bring it up with commodities. Commodities will move in the same direction for days and days in a row. So if you let those intraday trades start to bleed into day-to-day, week-long, month-long trades, you're going to be battling back for a while. But we have to move on, Pete, to rates and FX, because ranges are widening here too. It really seems, Pete, like it's everywhere but equities, especially on a day like today. It doesn't seem like much inside days in rates and dollars here to kick off the week, but rates were significantly lower around the open today. Big bounce back in yields and just great intraday trades for all three of these, really, S2Y, 10Y, and 30Y. And that dollar now getting through recent highs above 147 already to start the week. I think we have to figure out something to do with this dollar. Maybe it's a pairs trade or something else. And with that, Pete, I'll line you up for the pairs of the week. Everybody's favorite segment here. I'm going to give Pete 3 pairs trades. He's going to rank his favorite to his least favorite, starting out with a metals market that is getting cheaper and cheaper by the day. But when you line up gold against gold and silver in the SPRE futures, looking at GLD versus SPRE, you actually see a very different looking chart. Gold vastly outperforming precious metals on the whole. So I'm looking there at one SPRE contract, long to about 30 to 50 deltas in GLD. They're looking at maybe like a 30 delta call spread or something like that. But that's how I would line that up. I would line it up one spree contract to about 30 to 50
Right.
shares of GLD if you were doing shares. But if you want to use the options, 30 to 50 deltas, maybe with a call spread or what have you. S30Y versus S10Y. And this is another good day to look at this one. 30-year yields have not only been depreciating, Pete, against 2 years and those short-term yields, but even the 10 years starting to bounce back against this 30-year that is just stuck in the mud. And I know that this is for reasons concerning the Fed potentially continuing to buy long-term debt, or maybe it's not the Fed, but you know the ins and outs. Either way, I know that this could be—
Just use the term chucklehead.
Chuckle, there you go. This could be a fundamental problem here where 30-year rates are held lower while 2s and 10s and 5s are brought up a little higher. I just like this as a reversion trade. This one, no matter what the news is or the fundamentals, this one usually moves out and then comes back. So I'm looking at one long S30Y versus one short S10Y, the old knob spread here, maybe just for a short-term play of 50, 60 bucks there. Last one, tech stocks versus small caps. Again, a good day to look at this one. This one just bounces back and forth, just when you think it's safe that small caps are going to start to take back some ground against technology. Technology puts in a day like today where they are screaming higher, looking at 3 short sticks against 2 M2Ks. They're long. All right, Pete, rank them.
All right. The true extreme is the knob spread. So I continue to like this trade, have this trade on, the compression there. And the true extreme, which is so nice to see, is you can just look at one minus the other. It's yield. I love the fact, granted, we have some ownership in these. We built these together with the team. It's such a simple way to trade yields that nobody ever had before. The ZBZN thing. Can you build that trade? Sure. Is it complex and very expensive? Absolutely. Here it's always 1-to-1. I think the knob spread is interesting. I am confused as to why it refuses to start to revert a little bit. And maybe it is chucklehead talk, whatever. It's a complacency that is a little bit paradoxical to me, but I'm not going to wonder why. I'm just going to trade the extreme and then manage around it. Sticks M2K, I've got that on in a lot of different forms. It is a unrelenting pair trade that that gives you little windows. You had a window Friday to manage that for a winner. And you could peel a little bit back, but you've got to be really deft to do that. I love that extreme. The gold spree trade, this is probably the most interesting extreme because you're right. In a down move, silver never leads the way down. Gold, usually that gold-silver relationship collapses. So that gold-silver ratio we've talked about before. How many ounces of silver it takes to buy an ounce of gold, the relative value of the two assets. On down moves, gold tends to fall further, faster than silver does. Just like on up moves, that ratio expands. So you've got the ratio doing exactly what it doesn't do in a down move, which sets up its own, again, don't worry about why. Just look at that. That's another tool fueling the extreme. Now, if you follow me on this one, you've gotten stung on this one because we have not reverted at all here. But I like, again, at $2 down, if you're disciplined around 50 to 60 cents, what's the daily move in spree right now, Frankie? What's that one?
Right now it's like 75 cents, but given the last 3 days entered into that, I would skew it up to like $1.10.
You'd risk $1. Okay, $1's fair at this extreme. So I looked to risk $1 to make $1. I like taking out the gold portion of it because it's not acting like it should. In other words, if this bounces, gold may just sit there and silver's going to bounce. I'd rather get some theta and reduce cost basis with the GLD short call. So I'm going to back up. I love the knob because of the historic extreme and the simplicity of the product. GLD and spree is probably the most interesting trade on the board. And then Sticks M2K, I got on, and I'm going to continue to have it on. It's painful, but you know what? I'm almost at a point, though. It's funny. We talk about this once in a while. When your traders put themselves in a box. I'm close. I'm not, the box isn't fully sealed, but I'm eliminating my ability to actually trade that spread from both sides because of the extreme. And that's a dangerous spot to be in. And you're reliant on, I don't want to say hope. You're still trading the extreme, but mechanics are incredibly important then. And there is no too high a level to get out when you reach your pain point. But there's my take on it.
Very cool. Yeah, I like that. Instead of ranking them this week, you gave them superlatives. You were like, the knob is the biggest extreme, gold is the most interesting extreme, and technology is the one that is killing me the most. But either way, we'll take it, Pete, and we will get out of here because we have Splash into Futures coming up next. We'll look at those pairs trades and more futures stuff. We got to get something going with the U.S. dollar. I don't know quite yet what that is, but that thing is creeped back to new highs in recent months, and I want to figure out what we can get cooking. You'll see what we get cooking in the next segment. Thanks for watching, everybody.